Hello and welcome to Behind the Charts. I'm Dave Keller, the Chief Market Strategist at StockCharts.com. Today we're going to feature a conversation I had at the Money Show in Orlando with Eric Balchunas. Eric is the Senior ETF Analyst at Bloomberg, based in the New York area. I enjoyed talking to an ETF expert about a lot of the questions I've heard about ETFs over time. Structural challenges, what would happen because all these ETFs have been created in a bullish market phase. What happens when the market goes down? What does that mean for ETFs? Are there solvency issues? Eric knows better than anyone about what potential issues there are, also a lot of the opportunities that investors might not necessarily be aware of. He also did a very good job of reminding me a number of times that buyers of ETFs should always be wary of what they're buying. And it's all about awareness, knowing what you're purchasing and going underneath the hood to understand what is creating all the movements in the ETF, from expenses to construction to rebalancing and so forth. So here's my conversation with Eric Balchunas, Senior ETF Analyst at Bloomberg. Hey everyone, we're here at the Money Show in Orlando. I'm here with Eric Balchunas from Bloomberg Intelligence. He's the Senior ETF Analyst there. Eric, thanks for joining me. I really appreciate it.
Here. Yeah.
Can you, just for people that are not familiar with your work, I followed your work on Bloomberg, you're writing for Bloomberg Intelligence. Tell people just how you got to this point. How did you become interested in ETFs? How did you get into that part of it?
Yeah, it was a weird road for me. I was a journalist and institutional investor right out of college.
Oh, right, okay.
But then I would talk to PR people who seemed to be behind the keyhole.
Okay.
So I wanted to go behind the keyhole. So I took a job in PR.
Okay.
So I worked at a crisis management firm, and then I got a job at Bloomberg in PR.
Okay.
But then after 9/11, I moved down to Jersey from Manhattan, and the Bloomberg Princeton office was closer, but all they did there was data.
That's right.
So by happenstance, I ended up in data from PR. Nobody's ever made that move in Bloomberg history.
Right.
So it was an odd one.
A first.
At first I wanted to leave, but then I was like, this is how the terminal's made. We were like the Keebler elves.
Yep.
You remember that commercial, Time to Make the Donuts?
Yeah.
It was like, time to make the data. That's what we did. So I got handed ETFs in 2006, and having covered funds for institutional investor, I started to kick the tires on the ETF, and I was like, damn, this thing is like 4 or 5 steps beyond the mutual fund, not just one. It's a game changer. Yeah. Like the MP3 is how I equate it. It's like, you're like, this is going to really do some damage.
And that's sort of early on, like 2007, 2008, that's pretty early on in ETF land.
Oh, right? I was a man alone for about 10 years, believe me. I was fighting for programming resources because, like, look, you got to build out DES pages. You got to add things like, how's the index weighted?
Yes.
What's the premium discount? Like all these things that are ETF-ish. And I will give shout out to Index Universe, which is now ETF.com. They were way ahead. So they gave me like a guiding light. And I was like, this is the future. So I would sort of read them religiously, look at the way they talked, and then try to absorb it into my own style and evolve the terminal and the data. So I did that for about 12 years. Yeah. And then I was writing a little bit on the side, and research was started inside Bloomberg, and the research head, who used to ask me for ETF tips sometimes, because it's for normal people, ETFs are just an easy, if you see like Brexit, and you're like, you have an opinion on it, like, I think the pound is going to go down. Right. If you're a retail investor, it's very difficult to work that out, but there's an ETF for everything now. That's right. So even like sophisticated people will use ETFs in their PA. So he asked me to come over and lead the ETF research at Bloomberg Intelligence. Got it. And so if you think about it, research is a combination of journalism, data, and a little PR, because now you have to be your own marketing person as a research analyst. So I've been doing that for about 4 years, and that's all I do all day. So I write research on ETFs for the Bloomberg Terminal. And then on the side, I hosted a TV show with Scarlett Fu on ETFs called ETF IQ. Got it. And a podcast with Joel Weber called Trillions. Trillions, that's right. I got to work the plugs in.
We got all of that. We got all that on here. You're good.
I say that because if you're not a terminal subscriber, which a lot of people aren't, that stuff's free. Yeah. So I point that out.
And on social media, you're pretty prolific, like on Twitter. I was going to say, I've seen your comments on that.
We post charts on Twitter as like little samplers. Yes. You know, like the person at the mall giving out the, that's like us on Twitter. Yeah, little nugget.
So can you tell us a little bit about your process, particularly any sort of charting inputs that you use? Because obviously at StockCharts.com, we're thinking about how people are visualizing data. How do you visualize ETFs, and what's your process of consuming what's happening in the ETF landscape?
Yeah, there's I think 2 big things we look at. Okay. The first is flows. The reason ETF flows are so amazing is because they're daily and they're fine-tuned. It's as fine-tuned as you can get on sentiment, and institutions use ETFs. Sure. So for us, flows are, show me the money, follow the money. Right. ETFs give you the best take on what's going on. But sometimes there's false positives, and sometimes it's a little, flows can trail price, and they can trail volume. So we also look for price action, we look for volume.
Right.
We're just looking for outliers.
Sure.
We're also looking for, I use the equation of surfing. We're trying to spot swells.
Oh, that's good.
A
I
lot
like
of
that,
times the mass media will follow it when the wave breaks. They'll be like, robotics is a big deal. We want to catch that robotics trade way ahead. So we look for, is this ETF punching above its weight in flows? It took in $2 billion last year, but it only has $2 billion in assets. So it's grown by 100%, and that's 100% in the billions. Okay, what's going on here? We'll dig into the industry. We'll look how the index is designed. We'll see if there's competing ETFs launching. And so we'll try to get ahead of these trends, for investors.
Right.
We also do big, giant studies on active passive.
Sure.
People love reading about that.
Of
I'm not
course.
sure if it's out of fear. Vanguard, believe it or not, gets a ton of readership on the terminal. You wouldn't think, why would Vanguard?
Right.
I think it's like fear reading, because it's like reading about Amazon if you're in retail.
Yeah.
So people are concerned about what ETFs are doing just if you're in the asset management industry. But our main goal is to try to spot things for investors. Like recently we looked at uranium. There was a new uranium ETF that launched after a 10-year route where the index was down 80%. You never see an ETF launch after a back test that's that bad.
No.
They always launch after a great back test, right?
Yes.
So it got our attention. We started looking into it. We found out that your nuclear energy would be a great solution for climate change.
Okay.
It would keep the economy going because wind and energy won't get you there. So they're a great bull case for it. Now, we're not saying it'll happen,
Right.
but we're kind of pointing it out like, here's a unique situation. These uranium miners plus are beat up. So the littlest catalyst, you can see a lot of upside.
Yeah.
So we don't go to say it's going to go up. We don't make calls.
Right.
But it's part of a larger report we did on losers of the last decade.
Okay.
And we try to give you here's why they lost, but here's one or two reasons they could pop.
Yeah.
We don't know. And so we're just trying to find those things. I always equate it to that movie There'll Be Blood?
Yes. Yeah.
When Dale Day-Lewis is deep in the mine looking for gold at the beginning.
Yeah.
That's us in data. And what we do is
it.
we just send up little diamonds.
Yeah.
Little things that just make our team go, this is interesting, something's here.
Yeah.
Or that's odd. And we just send that up and we put that into a research note, and hopefully that factors into the intel of our client, and then they can make their own decision.
You hit on so many little things I'd love to explore further. One, you hinted at a theme that I think a lot of people have picked up on, which is a theme becomes really prolific. A lot of people get interested, and then an ETF comes out. And anecdotally, it feels like that's sort of when the theme is over, right? Have you done any analysis? Have you found that there's something there, or is that more just an anecdotal thing that we think about?
In factors and smart beta, that's when you tend to have the good back test be bad in reality.
Okay.
Themes are a little different. It depends on the theme.
Okay.
Cannabis came out.
Yep.
That MJ was pretty early, went up, which had a great year, then a horrible year.
That's
so
true. Yep.
it's mixed.
Yeah.
Robotics, I would argue, came out before that industry popped.
Yeah, sort of emerged, right? Yeah.
And then other ones come out after the fact. I mean, it's a mixed bag on the themes. I think where you gotta double check is factors and smart beta, because factors and smart beta honestly are active management repackaging themselves. And they tend to live and die off of that track record. So they like the back test to look good. And there's been studies that it can also go up. Anything growth has continued to work.
Well, sure.
But I think anything fundamental. So there's a lot of variables, but we always say there's no such thing as a bad back test. That's why this uranium miners ETF, we're like, okay, well, our saying is now, there's now an exception. The junior uranium miner launched after an 80% decline. So, but largely speaking, don't trust the back tests.
Right.
Really look at the strategy. Look at what it's doing. We also have a big thing on cost. Because a lot of people want to, balance out that thing of liquidity, cheap to trade, but also cheap to hold.
Yes.
And how long are you holding? Because you might want to go to the liquid one if you're short. If you're going long term, you probably want the cheaper one. But then, of course, the way the thing is weighted is huge.
Yes.
Like we just had a study on 2 dividend ETFs. One weights by the dividend yield. So it ended up holding all these small caps that were going down.
Yes.
One that holds by market cap did better. But that might be counterintuitive.
Yeah.
This is the kind of stuff we try to get out there. When we go deep into index weighting methodology, our readership will decline, but hopefully it's a much richer experience.
A valuable message, though, right?
Yeah. And most people sort of just, going into the index is the most important thing you can do as an analyst or an investor.
Sure.
But it's also one of the most boring. It's almost like going to your auto mechanic and him starting to explain the brake pad situation. You're like, dude, just do it. It's fine, just go.
Well, you hit on a really good point. I think a lot of ETF investors get really focused on the expense ratio as like the thing, and you want to go low cost.
Yeah.
But you're hitting on, there's so many other complexities that people, I feel. And also, can you talk just a minute about not, ETF-like products that are not ETFs? What should people be looking for? What should they avoid? How should they approach those, do you think?
A great example is Tesla. Tesla's on this huge surge, came down a little bit. Anyway, Tesla's not in the S&P family, but it's in the Russell family.
That's right. Yep. Okay. Yeah.
Because S&P is a little more stringent. You need 4 quarters of profitability. Plus, there's a committee. People don't even know this. That's the S&P. So the index weighting methodology isn't just reserved for these weird theme ones.
Right.
It's across the board. Now, in terms of your other question on ETF, what do you mean by ETF-like?
Something like ETNs, unit investment trusts, things that feel like ETFs but are not, and a lot of people just kind of mentally bucket all of those things as things like a stock that give me a basket, but they aren't really. What should investors think about though? How should they consider them?
Sure. So we have this thing we call the traffic light, and it's like movie ratings for ETFs.
Right. Okay, sure.
Because you can't say this ETF's dangerous and this one's safe.
Right.
There's middle of the road ones, like the senior loan ETF. It's holds the liquid stuff, but it's also long only.
Yeah.
It's an ETF. Then there's certain ETNs that are pretty safe. I mean, they just track the MLP industry and they're better on taxes.
Right.
So it's a nuanced thing, right? But I would say largely, if you're doing ETF investing and you stick to the big liquid ones, you're going to be in the plain vanilla. 90% of the assets are in plain vanilla, open-end
pretty
ETFs.
Liquid stuff. Yeah.
That 10% though is in the oddities. We call them the exotics, the fringe.
Okay.
But those can be interesting. Leverage ETFs, if you're a trader, can be powerful. But those are red lights. We say, you got to be quick. You cannot hold these. Futures commodity futures ETFs is a big one, like USO, the oil one.
Yes.
That is probably the ultimate. That was really the inspiration behind our system, because something like USO, if the SEC comes out with this derivatives rule where it might ban triple leveraged, USO wouldn't be affected. And I say to somebody, USO to me is a wolf in sheep's clothing because it's called the oil fund. Oh yeah, I'm going to bet on oil. The cost of rolling the futures, if you're going to maintain that front month position,
eats away
could
at the
be
returns.
20 to 40% a year. Imagine a mutual fund where the expense ratio was 20%. So the name should be the United States Oil Fund plus crippling roll costs, ETP, but yet that wouldn't be in the SEC rule. So
that's right.
We've made this system akin to movie ratings that helps you get advanced information on potential nasty surprises.
Right.
And you're right, ETNs come with credit risk.
Yes.
Although there's only been 2 defaults ever, Bear and Lehman, and their ETNs had no assets. So on an asset-weighted basis, there's really been no problem with ETNs actually defaulting on that credit situation.
Right.
So a lot of people like ETNs in the MLP and future space because they get taxed like you hold Microsoft, so normal.
Yeah.
Whereas if you hold futures or MLPs in the ETF wrapper, you're going to get a odd, alternative, unfortunate tax situation.
Sure.
So ETNs become a tax loophole, so they can have a benefit, but you sort of have to weigh all these things. And that's why I think I have job security.
Right?
Yeah, no, I'm all about all this stuff.
Yeah, but you're right. So you need to have a good awareness of what you're actually getting exposed to.
But most of the money goes to the
liquid
stuff. Yeah,
it
goes to the big liquid or the big cheap ones, and that's largely funds, open-end, SEC approved, ready for prime time.
I'd love to ask you this question just because of your expertise with ETFs and the data behind them. Working with institutional investors, we would often speculate when a stock would have a big move 30 years ago, that meant a bunch of big institutions were buying the stock, were buying Facebook, and that's what was driving it higher. Now there's more speculation, is that just a bunch of big S&P-like ETFs that are causing that demand? How would you think about that demand on individual names versus the demand that's sort of created by ETF flows?
Yeah, it's a good question. Here's a great example.
Yeah.
GE. I use this example. I think ETFs can provide maybe a touch of amplification or a buffer, because when GE's, and this is a chart I use when people worry about ETFs, the tail wagging the dog. GE went down like 42% in 2018 over a 6-month period or something like that. But the ETFs that held GE all took in a bunch of money. So would GE have gone down 44%? Maybe.
Right.
So I think that's how you have to look at it. I also think that you have to understand a lot of big active mutual funds, they have to kind of buy and sell around the index as well. They call that closet indexing. So if you look at the holdings of the Fidelity Magellan, it's going to hold it's going to look like the S&P for the most part. It has to. A lot of them are trying to maintain assets. They don't want to take big risks.
Yep.
So what we tend to think is if there is an issue that you should think about, it's called the beta vortex.
Okay.
Passive is beta, but so is a lot of active. And now the ETFs that sell well, that are smart beta, tend to lean beta. Sure. And now even hedge funds that are long only tend to get more of the flows. If you go long short now, you're not getting money.
Right.
So what's happening is the more beta-ized you are, the more investors are buying you. So to me, this isn't the function of, it's not any of their problems. They're just fulfilling demand.
Right.
So the investor maybe could be having a self-fulfilling prophecy of keeping demand in beta, and those growth names are lifting it up.
Yeah.
And could there be could the beta vortex, pop?
Right.
But it would harm everybody.
Right.
So we're all in this together. ETFs are one component.
Yes.
But as 16% owners of most stocks, they're not the tail wagging the dog. There are a few pockets of the ETF world, like REITs, where there's been a couple cases where ETFs ownership has gone up to 20%.
Sure.
And we monitor them, we look at them as canaries in the coal mine a little bit. But even in those cases, active will still get involved, and I look at those cases sometimes as a bunch of cross currents mashing together.
Yep.
But the ETF issuers also do a good job, even if they own a lot, of maybe hedging that selling of the index or buying it, so that they unwinding of that trade over a long period of time with the bank.
Yeah.
They are not looking for bad attention. So I think in the exotic cases, there definitely are some areas where ETFs can have a big impact.
Okay.
Pound for pound, they're just too small at this time to do that.
Okay.
Well, but I do think that the volume of ETFs is enormous, and I think if anything, what they're doing is they're eating into the futures world a little bit. Maybe eating into the options or options on ETFs.
Yeah.
And maybe even eating into the single stock investing world. So the one, one thing I don't worry about it yet, but if more and more people just stop trading stocks and just use the ETF, you might see spreads in the stocks widen.
Sure.
And that in turn would create premiums and discounts because the arbitrage band to ARB the ETF would go up.
Right.
And that would be extra cost.
That'd be different. Yeah.
That would be at the margin, but so that's why I want stocks and bonds to be traded like crazy. So even though I'm an advocate of ETFs, I want them to compete with mutual funds and futures.
Yeah.
I think they should leave stocks and bonds alone. You want that to be liquid and buoyant and people analyzing all the data. That way there's great price discovery because the ETF should be an additive to that, not dictating it.
So one more question then that we have time for. I'd love maybe continuing on what you were just talking about. One of the concerns I've heard some people have with ETFs is most of them have proliferated during a cyclical bull market within a secular bull market. What happens when we have the next cyclical bear market, the next secular bear market? Are there structural things, or what would you look for? What signs or what guideposts would tell you, okay, there's an issue that's coming out of the fact that people are now selling ETFs instead of selling individual positions? Is there anything to be concerned about there, do you think, or no?
So, I mean, I'd look at some of the places where you'd expect some discounts to form, like junk bonds.
Sure, okay. Yep.
But 2018 provided a lot of samples. We're like scientists looking for samples and
good data, right?
Yeah. So we run right into that hurricane looking, and honestly, I think the biggest discount in HYG was of 1%. The reason I am confident ETFs will be fine is because the biggest, richest, smartest market makers all work them into their natural process. You got futures, ETF stocks, all working in harmony. And so they know how to arb it and keep it tight and give their investors a good shot. So in 2018, ETFs were at 3.5 trillion because we also look at 2008 where the discounts were deeper, but there was less money involved.
Sure, right.
But they still traded fine. And a lot of people, I think, came around in 2008 because ETFs traded good enough, close enough, and they could trade something liquid when other things weren't.
Right.
And sometimes an ETF can be like a futures contract where, you can trade futures when a market is closed.
Yep. Right.
You can trade let's say after 9/11, the stock market closed, SPY traded. So the ETF, in my opinion, is now a release valve.
Even most recently with China, right? With the news coming out of China, you could trade the ETF.
But you will see the ETF deviate from the NAV, but says more about the NAV being stale.
That's right.
That said, look, I don't want to say they're a miracle cure. I think they're not perfect.
Right.
We're always studying and watching them, and because we don't want to be on the hook saying you said these were fine, but we look at these sell-offs, we study them, and so far there hasn't been any evidence. We think sell-offs is when ETFs are going to grow at an even faster rate.
Got it.
We found that people will use the sell-off as an excuse to get out of their active mutual fund because they're locked in right now on capital gains.
Right.
So if there's a bear market, active is in for a world of pain, and a lot of that money is going to transfer over. It's locked in there right now. So I think bear market, you see ETFs grow. You just, at some point, how big can they get? Some people worrying about Vanguard and BlackRock, which have most of the assets. They now own 7-8% of companies. There's probably going to be something way down the road where there could be a new rule or regulation to make sure they're penned in.
Limited or something. Yeah,
but right now, I still feel like I used to call them a puppy dog. They're probably more like, dog. What's
mid-sized.
What's in between a puppy and a grown dog? Teenager.
Yeah, right.
Yeah.
2-3-year-old.
Yeah,
dog,
absolutely.
Maybe. Okay,
yeah,
fair enough.
What we sometimes worry about is when an ETF comes out to track something exotic, like XIV, or this dividend yield one from Spider that's weighted weird, or junior gold miners, GDXJ. And if one of those accidentally becomes like a smash hit, it can really, weird stuff can happen in that little market.
Right.
That to me is where we tend to see reverberations.
Got it.
If an ETF that wasn't supposed to be 5 billion grows that quickly, you can see that. So it's the mid and small cap stocks sometimes where I think you could see something. But again, I haven't seen any really evidence that would make me tell anybody there's anything to worry about. So I think people could trade their ETFs fine. They could use index mutual funds. And at the end of the day, all a market maker is going to do is look at the stocks and then be able to make you a market in the ETF, because the ETF can riff off the liquidity of the underlying basket. So some people say, well, what if everybody wants to get out of the ETF at once?
Right.
Well, I say to them, well, are people buying the bonds? In other words, are you telling me that if you own the bonds yourself, you'd be able to sell them instantly?
Right.
So a bad day is a bad day for everybody. So I tell people, think about this scenario. Let's say you want junk bonds. That's probably the area people worry about the most.
Sure.
You can own the bonds yourself. You can own HYG, or you can own like a high yield mutual fund. Okay, a bad day happens. Is it going to be easy to sell any of them?
Right.
Right.
Yeah.
And some people say, well, the mutual fund will give you the NAV, but they may have to sell bonds at horrible prices to get out. It's nothing perfect. A bad day is a bad day.
Yep.
And I think that's what you have to accept. ETFs aren't a miracle cure, but they are a decent option. But there are many options to get those exposures.
Yeah. This was great, Eric. And my favorite message that you shared was just knowing what you buy, right? Having an awareness of
and sometimes ETFs might not be the answer.
Right.
I used to see articles, I won't say the site, 5 ETFs to play Amazon earnings.
Right.
I'm like, you just buy Amazon. Yeah. So it's
That'll
true.
do it.
I believe it or not, there are cases when buying a stock makes sense.
That's right. Eric, this was awesome. Thank you so much.
You got it.
Here with Eric Balchunas here at the Money Show in Orlando. Eric's from Bloomberg Intelligence.